Audio Jungle. Audio Jungle.
The rule of 72. Double your investment. What comes to your mind when people talk about calculations and projections in finance and investing? Is it a suited person running operations on calculations and computers? Is it someone whose understanding of the market seems utterly out of reach for common folks such as you and me? Well, while films and popular culture have worked very hard to convince you that all investors are mathematical wizards having a certain amount of relevant training and education, in their resumes, I'm here to tell you the opposite is true. How? Keep watching this video and drop a like. So in this video, we are going to focus on what is the rule of 72 and how do we put it to use in the Indian stock market. How can this rule help you keep track of your investments? And what are some stocks a beginner can target to put this rule to use? Why do we need to know about the advantages and disadvantages of this golden rule? If you are someone who trembles at the thought of having to do multiple procedures and calculations only to keep track of your investments and involvements in the market and probably ends up deciding that maybe growing rich is not worth it, there's something you need to know. There is a simple mathematical trick that all types of people in the stock market employ all the time. This tool is in use by literally everyone, from the top-notch CEO of hedge fund to a rookie player on the floor. What's more, it has been in use for at least 500 years now. Feeling really dreadful right now for not knowing it? Alright. I'll cut to the chase and get to it. I would normally start explaining it in simple terms, but I regret to inform you that I can't. Because the formula itself is that simple, it cannot be boiled down any further. Here it goes. The time required by your investment to double is equal to 72 divided by the annual profit rate. That's it. It's literally that basic. N is equal to 72 over R. Let's get a deeper understanding of it using different examples in which we might find applications of it. The rule of 72 is employed by various investors throughout the globe, such as Warren Buffett, Jamie Dimon, Mohnish Pabrai, and so on. And it is used to estimate the doubling potential of investments, given the fixed annual profit rate. Important thing to be noted over here is that this rule works only with fixed annual profit rates. For example, if you are investing in stocks like Reliance Industries, Tata Consultation Services, or something like Nestle India, you're gonna get stable return rates in most cases. Now, all you have to do is to divide the profit rate by 72. Let's just make it more understandable. Suppose you're planning to pursue your master's at a reputable university, and for that, you have done some preliminary planning about the required money. Thanks to that favorite podcast of yours that helped you come across some reliable resources on YouTube and ultimately leading to this channel. You finally decided to invest in some growth stocks, such as Bajaj Finserv or Jubilant Food. Now, if you want to calculate how much time it's going to take your investment to double, so that you can actually manage your educational finances, then the rule of 72 can help you a long way. The rule of 72 helps you to estimate the number of years required to double your money at a given annual rate of return. Hence, if the rate of return is 8%, the number of years taken to double your money is 72 divided by 8 equals 9 years. Or conversely, if an investment advisor claims that the money invested in a debt plan will double in 8 years, the rate of return should be 72 divided by 8 equals 9% annually. Now, if you're more into bonds or equity funds or some popular mutual funds, you should always know the advantages this rule can help you gain. Suppose you have got your mind and money in some bonds. It can be any governmental bond. And you know that the government is giving you a coupon rate of 6%. You know you're going to sell the bond once it doubles your initial investment. But for that, you'll need to know how much time it will take to double your investment. Number of years to double your investment can easily be calculated by dividing the coupon rate by 72. Simple as that. The result in the aforementioned case is going to be 12 years. As the result is 12, it will take 12 years at the same rate of profit for your bond investment to double. This is how investors use the rule of 72 to have a clear vision of the value of their investments after a specific period in the future. Now, if you're thinking which stocks are the best if you're just starting in the stock market, then we have got your back because the best indicator of a company's reliability is its performance in the preceding years. For example, when we talk about the Bombay Stock Exchange or the National Stock Exchange, we can easily see that the Nifty 100 index has generated more than 20% CAGR, compound annual growth, in the last 20 years. This is easy prey, folks. Make sure that you look deep into companies before actually throwing your money in. For example, if someone persists that you invest your money in the S&P BSE Sensex, and the reason given was that it can help you double your money, you should know that it has provided investors with negative returns in the last month or so, and is currently subjected to high volatility. It is right said that if one stays invested in the equity markets for longer term, the investment is likely to generate magnificent returns in the long run. Mr. Warren Buffett says, if you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes. Eicher Motors is one of the leading companies in the investing landscape and is probably the leading automobile stock out there. Similarly, Bajaj Finance generated CAGR worth 58% in the last 10 years. These are gold in the mud stocks for a beginner investor to get in. Now, if you can get your money in these heavy market capitalization stocks, you can use the rule of 72 to estimate when your money is going to double. Because ideally, the aforementioned stocks are going to provide you with a pretty much constant annual profit rate over the course of time. However, make sure you give a thought or two to some disadvantages that might be coming along. Firstly, you need to know that the rule of 72 works best for profit rates somewhere between 6 to 10%. And if you're lucky enough to get that rate up to 8% or even 10%, the profit rate will fluctuate. If the profit rate changes due to some reason, the estimated time might not give the accurate value. The rule of 72 does not work with investments that have a changing profit rate and for investments with simple profit. Now, this debate does not mean that you should be solely dependent on historical returns of certain companies and then employ the rule of 72. You should also consider the fundamentals of the company before actually deciding which stocks to go for. A few things to keep in mind if you are that type of person who craves for details and aims for precision. The rule of 72 works best when the profit rate is closest to 8, because it was initially worked out for values in this range, and to be fair, most profit rates you will encounter in the practical world of investing are in this range. But suppose you deviate significantly from this. Just keep in mind then that for every 3 digits you move from 8, adjust by 1. If you move 3 digits up, add 1. If you move 3 digits down, subtract 1. Suppose you want to calculate the doubling potential of an investment with the annual profit rate of 5%, 3 digits below 8. You simply divide 71 by 5 instead of 72. Why then did they call this rule the rule of 72 in the first place, you might ask? Well, because 72 had the most factors and is the easiest to deal with and provides pretty decent answers for real world situations. Second thing to keep in mind, there is something called continuous compounding in which your profits are being compounded to the initial sum all the time continually. People do this to get higher returns fast. If you're dealing with a situation in which continuous compounding is being practiced, simply replace the 72 with 69.3. That's it. You're now as precise as you can be. So, what do you think about the golden rule of 72 and which stocks are you planning to invest in? Is it going to be some mutual fund? Or are you looking to get those quick bills through dividend stocks? Let us know in the comment section below. Make sure you press the like and subscribe button, and we'll see you in the next video.